A mortgage is almost certainly the largest financial commitment you will ever make. Most people spend more time researching a holiday than they do understanding the product that will cost them hundreds of thousands of pounds over 25 years. Today, we are fixing that. In this episode, how mortgages work and what you're actually signing up to, how lenders calculate what they will lend you and at what rate, the difference between fixed, variable and tracker mortgages and when each one makes sense, how your deposit size changes everything, the hidden costs most first-time buyers miss, and the specific steps to take before you ever speak to a lender. A mortgage is a loan secured against a property. You borrow money from a lender, purchase a property with it, and repay the loan plus interest over a fixed term, typically 25 years in the UK, though terms from 10 to 40 years exist. The word secured is the critical part. Unlike a personal loan, a mortgage is backed by the property itself. If you stop making payments, the lender has the legal right to repossess and sell the property to recover what they are owed. This is why lenders scrutinise your finances carefully before agreeing to lend, and why understanding what they are looking for gives you a significant advantage. Most lenders in the UK will offer between 4 and 4.5 times your annual income as a mortgage. On a salary of £40,000 that is between £160,000 and £180,000. With a joint application on a combined income of £70,000 that rises to between £280,000 and £315,000. These are not fixed rules. Lenders also assess your outgoings, existing debts, credit score, and spending patterns. But income multiples give you a reliable starting point for understanding what you're likely to be offered before you begin the formal process. Your deposit is the single most important variable in a mortgage application, not just because it determines how much you need to borrow, but because it directly determines the interest rate you will be offered. Lenders use a figure called loan to value, LTV, which is the percentage of the property price you're borrowing. A 10% deposit means a 90% LTV. A 25% deposit means a 75% LTV. The lower the LTV, the less risk to the lender, and the better the interest rate they offer. The difference between a 95% LTV mortgage and a 75% LTV mortgage on the same property can be over 1% in interest rate, which on a £250,000 mortgage translates to hundreds of pounds per month and tens of thousands over the full term. There are two fundamental types of mortgage repayment structure. Repayment, where each monthly payment covers both interest and a portion of the outstanding loan. Over the full term, you pay off the entire debt and own the property outright at the end. Interest only, where each monthly payment covers only the interest, and the original loan amount remains unchanged. At the end of the term, you still owe the full amount you borrowed. For residential mortgages, repayment is the standard and in most cases the right choice. Interest only is primarily used in buy-to-let. If you're buying a home to live in, you almost certainly want a repayment mortgage. 3 mortgage types to understand. A fixed-rate mortgage locks your interest rate for a set period, typically 2, 3, or 5 years. Your monthly payment does not change regardless of what happens to interest rates in the wider market. Certainty and predictability. A tracker mortgage moves in line with the Bank of England base rate plus a set margin. If the base rate falls, your payment falls. If it rises, your payment rises. A variable rate or standard variable rate is your lender's own rate, set at their discretion. You typically end up here when a fixed deal expires and you have not remortgaged. It is almost always the worst rate available, and remortgaging before you reach it is one of the most straightforward ways to save money on a mortgage. Most people think about a mortgage in terms of monthly payment. What they rarely calculate is the total amount repaid over the full term. On a £200,000 mortgage over 25 years at 4.5%, you will repay approximately £333,000 in total. That is £133,000 in interest, on top of the £200,000 you borrowed. At 5.5%, the total rises to approximately £369,000, £169,000 in interest. The difference between those two rates is £36,000 over the lifetime of the mortgage. This is why securing the best possible rate matters so much, and why every percentage point of interest rate is worth taking seriously. Here is something most people do not realise about how mortgage repayments work. In the early years of a repayment mortgage, the vast majority of each monthly payment goes to interest, not to paying down the loan. On a £200,000 mortgage at 4.5%, your first monthly payment might be around £1,100. Of that, roughly £750 goes to interest, and only £350 reduces the outstanding balance. By year 20 of a 25-year mortgage, that ratio has reversed. Most of each payment is reducing the loan. This front-loaded interest structure is called amortization, and understanding it explains why overpaying your mortgage in the early years, even modestly, has a disproportionately large impact on the total interest you pay. Buying a property involves costs well beyond the mortgage itself that most first-time buyers underestimate. Stamp duty land tax on properties above £125,000 for first-time buyers, though the thresholds and rates change, so always check current rates before budgeting. Solicitor and conveyancing fees, typically £1,500 to £3,000. Survey costs, from a basic mortgage valuation at a few £100 to a full structural survey at up to £1,500 on an older property. Mortgage arrangement fees, some of the best rate deals charge a product fee of up to £1,500, and removal costs, which are easy to forget until the day arrives. The total buying cost beyond your deposit is typically between 3 and 5% of the purchase price. Budget for it from day one. When a lender assesses your mortgage application, they are building a picture of risk. 6 things carry the most weight: your income, both the amount and its stability; employment type matters. Employed applicants are assessed differently from self-employed. Your credit score and credit history, as covered in the last week's episode, this directly affects the rate you're offered. Your existing debts and monthly outgoings, your deposit size and where it came from. Gifted deposits require documentation. The property itself, lenders will not lend on certain property types or conditions. And your spending patterns, lenders now review bank statements, and unusually high discretionary spending in the months before an application can affect what you are offered. The mortgage application process follows a predictable sequence. First, get a decision in principle, also called an agreement in principle. This is a soft confirmation from a lender of how much they would be prepared to lend, subject to full checks. It does not involve a hard credit search in most cases, and is an important step before making offers on properties. Second, make an offer on a property and have it accepted. Third, submit your full mortgage application, at which point the lender conducts full credit checks and instructs a valuation. Fourth, receive your formal mortgage offer. Fifth, instruct a solicitor, complete the legal process and exchange contracts. Sixth, completion. The full process from accepted offer to completion typically takes 8 to 12 weeks. The fixed versus tracker decision is one of the most consequential choices in a mortgage application, and the right answer depends on your circumstances. If you need certainty, if your budget is tight and you cannot absorb a payment increase, a fixed rate is almost always the right choice. If rates are at a historically high point and expected to fall, a tracker can save you money if they do. If you are planning to sell or remortgage within a short period, a 2-year fix or a tracker with no early repayment charges may make more sense than a 5-year fix that locks you in. The key principle: match the mortgage structure to your actual financial life, not to what sounds most impressive. Most repayment mortgages allow you to overpay by up to 10% of the outstanding balance per year without early repayment charges. Overpaying reduces the outstanding loan, which means less interest accrues on a smaller balance every month. The compounding benefit of even modest overpayments is significant. On a £200,000 mortgage at 4.5% over 25 years, overpaying £200 per month from the start would save approximately £28,000 in total interest and reduce the term by over 5 years. You do not need to overpay every month. Even occasional lump sum overpayments, when you have surplus funds, produce a meaningful long-term benefit. Remortgaging is the process of switching your existing mortgage to a new deal, either with your current lender or a different one. It is one of the most reliably high-value financial actions available to homeowners and one of the most commonly neglected. When a fixed-rate deal expires, typically after 2 or 5 years, you automatically move to your lender's standard variable rate, which is almost always significantly higher. Remortgaging before this happens can save hundreds of pounds per month. Start looking at your options 3 to 6 months before your current deal expires. A whole-of-market mortgage broker can compare every available deal, and in many cases their service costs you nothing. They are paid by the lender on completion. Several government schemes exist to help first-time buyers. The Lifetime ISA, covered in Episode 2, gives a 25% government bonus on savings used toward a first home on properties up to £450,000. The Mortgage Guarantee Scheme allows lenders to offer 95% LTV mortgages backed by a government guarantee, enabling buyers to purchase with a 5% deposit. Shared ownership allows you to buy a share of a property, typically between 25 and 75%, and pay rent on the remainder, with the option to buy further shares over time. Each scheme has eligibility criteria worth checking carefully. But for first-time buyers, the combination of a Lifetime ISA and a 95% LTV mortgage can make home ownership genuinely accessible on a modest income. 6 steps to take before you apply for a mortgage. 1. Build your deposit to at least 10%, ideally higher. Every 5% reduction in LTV opens meaningfully better rates. 2. Check and improve your credit score across all 3 agencies. 3. Clear as much existing debt as possible. Car finance, credit cards, loans all affect affordability calculations. 4. Avoid applying for any other credit in the 6 months before a mortgage application. 5. Keep your bank statements clean. Reduce discretionary spending in the 3 to 6 months before applying. 6. Speak to a whole-of-market mortgage broker before approaching any lender directly. They have access to deals that are not available on the open market, and the advice costs you nothing. 3 mistakes that cost first-time buyers significant money. First, applying directly to a lender without using a broker. A broker with access to the whole market will almost always find a better rate than walking into a high street bank. The difference on a 25-year mortgage can be tens of thousands of pounds. Second, not factoring in all the buying costs. Underestimating the costs beyond the deposit is one of the most common reasons purchase chains fall apart. Budget for at least 3 to 5% of the purchase price in additional costs. Third, waiting for the perfect rate. Rates will always feel uncertain. The cost of renting while waiting for a marginally better rate frequently exceeds what you would have saved by acting sooner. A mortgage is not something to navigate blindly. It is a structured financial product with knowable costs, understandable rules, and significant room to optimize, if you understand how it works. The steps are clear. Build your deposit, improve your credit score, keep your finances clean, use a broker, act before your fixed deal expires. None of these require perfect circumstances. They require preparation. The difference between approaching a mortgage with understanding and approaching it without is not a rounding error. Over a 25-year term, it is measured in tens of thousands of pounds. Next week, we are covering budgeting, how to build a system that actually works with your life, the frameworks that consistently work, and how to find money you did not know you had. Subscribe so you do not miss it. New videos every week.